Thank you all for joining us with one of our top high cash value life experts, Denise Boisvert. If you're joining us for the first time, you may not know me. I'm one of the founders here at InsuranceandEstates.com and have a background in estate planning law. Denise works a great deal with our high cash value whole life clients. And Denise, do you want to say a little bit about you?
Sure. First of all, I'm really excited to do this webinar on college funding because I think it's a really big advantage for a lot of people and not taught very much of the opportunities and the options that they have when it comes to college funding. But I've been in the insurance industry for over 19 years. I love doing high cash value life insurance because I just think it's so beneficial in so many ways for so many people. And there's not a lot of education out there on it. So I love educating people on that. But I have clients, all over the United States, very busy with this. This is all I do. So I'm very familiar with the carriers and their products and how they compete with one another. So I really feel like this webinar is going to help a lot of people, not only with college funding, but just opening up their eyes to see how you can use it for a lot of different things.
Right. So kicking off the topic, so permanent life insurance versus 529 plans. So really, you've done a lot of work, Denise, in the area of helping people utilize this product or this particular vehicle for college saving and funding. So we're going to dive into these areas. We want to review the attributes. A lot of people maybe are thinking about a 529. So we want to help you guys understand that a little better. If you're just starting to research, what in the world, permanent life insurance is all about, and in particular, high cash value life insurance, we'll offer some feedback on that. That's one of our primary focuses here at Insurance and Estates, and Denise is right in the arena of helping folks with that every day. Various pros and cons of both 529s and high cash value life, and then Denise has a little treat in store here toward the end of our webinar with an actual example of how high cash value whole life can be used for college saving and funding. And Denise, would you say this is an alternative to the mainstream approach?
It is an alternative, and it's a good alternative. All right. So first of all, 529 plans are state run, and they're very similar to a Roth 401k or a Roth IRA, but they're intended for education and retirement savings. And if you're not familiar with what a Roth is, it's after-tax money that's going into an account that can grow tax-free for when you need to use it, with obvious basic retirement restrictions attached to that.
Right.
And the 529 also has restrictions attached to it. But the 529 is usually invested in mutual funds, and your earnings will grow tax deferred.
There's no guarantees, right? This is pretty similar to your typical retirement account in that regard.
Correct. Yes. I mean, the 529 plans, if they're in, a lot of people think that mutual funds can't lose money, but anything in the stock market can lose money. It's not always a sideways investment. So yeah, so there is that risk of what will you have when you actually are ready to use your 529 plans. And I have some people that had 529 plans and they've put a lot of money in and they don't have as much as they've put in. So that's another drawback. The problem with the 529 is the money is grows out tax deferred as long as you use it the way the IRS wants you to use it, which is a qualified education related expense. Then your withdrawals will be tax free. But if it doesn't fall into their category of education related, then it's taxable. So you've kind of thrown it in there probably for not a advantageous result. You'll get a penalty for early withdrawal.
Maybe we'll talk about this with pros and cons, is that if you do use it for qualified education, then you have tax-free withdrawals, which is, you could argue, is better than your traditional IRA.
There is another consideration that you need to make. If you are in the income brackets of being able to apply for financial aid, 529 plans can actually hurt you because you're putting money away into a 529 plan, and they're taking that money and they're saying, okay, that money you have, so we're not going to add that to your financial aid package because you already have it. Whereas had you never saved it, you may have gotten that money in financial aid, if that makes sense.
Yeah, that's sort of a teaser to one of the advantages that you're going to bring up down the
Right.
down the
Yeah.
road here. So those are some overview characteristics of 529s. Very similar to the traditional retirement account with some advantage for qualified education. So here, Denise, what are we looking at?
So here we're looking at permanent life insurance. And this is really attractive for college funding for a variety of reasons. Just like a 529 plan, the growth is tax deferred. I have to say tax deferred, but it's actually tax free if you take it out as a loan. But I want to be politically correct in saying that it's tax deferred and will most likely be tax free, like I said, when you withdraw it, as long as you withdraw it through policy loans. A 529 plan, the growth is not guaranteed and it's not protected from market downturns, but the permanent life insurance is not invested in the market. It really has no connection to market fluctuations because basically it's guaranteed interest with dividends that are paid by the insurance company based on their mortality and claim rate. It's not really based on the stock market. So it just makes it a really safe investment. Whole life insurance is probably the safest permanent life insurance out there.
Mm-hmm. Mm-hmm.
But one of the advantages of using a whole life policy for college is the flexibility and the diversification. If something happens to one of the parents, maybe they become disabled or even, an unexpected death, you have the death benefit of that permanent life insurance to help your child stay in college. Because now you've got a big sum that you would not have had with the 529 plan. So that's kind of, that's just a safety net. And I've just found over the years that most of my clients are more apt to save money for college in a permanent life because they have the comfort of knowing that if something unexpected happens, they have access to those funds. Whereas a 529 plan, you don't.
You're getting guaranteed growth, plus you have the tax-free advantages, and then you're also getting additional flexibility.
Yes. And one major advantage over a traditional 529 plan is that if your child decides not to attend college, because it is not a guarantee, folks,
Right.
Those funds are not lost and they can be accessed for any purpose. You can, say, all right, I didn't use it at college, but I'm going to use it for retirement income down the road. If they receive a scholarship or they attend college, they take a different path, your policy's cash value is not tied to their decisions. You still have the cash value, you still have the death benefit. You can access it any way you want without any kind of tax penalty. And then another advantage too is if you are applying for financial aid, any cash value in your life insurance is not considered an asset on the FAFSA form. And I actually have a lot of clients that will do this specifically to take money out of the bank, take $40,000 or whatever they have out of their bank accounts and put it in here so that it reduces their expected family contribution on that FAFSA form. So it's just kind of a loophole how you can kind of maximize what you're going to get for financial aid.
It sounds like become your own banker in a sense. So let's talk about, scenarios for people thinking, is this right for me? If you want to ensure college saving goals are met, this could be potentially very advantageous just from the standpoint of the guaranteed growth, the interest and dividends that you mentioned, Denise. We always talk about trading an account for a contract. Folks need to remember that with a 529, you've basically got an account. There's no guarantee that it's going to grow. It could take major hits as the markets have been taking as we record this. It could take a long time to recover that. And this is a different structure, and contractual growth rate. It also could complement traditional college savings, correct?
Mm-hmm.
Yeah.
Absolutely.
Yeah, we talk about that with retirement planning as well. If someone's got a traditional IRA, that policy component to the retirement plan it can really change the math in terms of people not outliving their retirement. Similar here, if you've got a 529, this can be an additional funding solution that maybe could be for things that are outside of the scope of what the 529 allows.
Yes. And also I think when people use this vehicle, they don't restrict as much, like I said before, of what they want to put into it. Right, because they're kind of afraid to put a lot into the 529 because what if Joey doesn't go to college?
Yeah, exactly. And that goes to number 3 here, which is flexibility. People feeling comfortable. This product has riders attached to it that can be used for chronic illness and all kinds of things. And then, of course, multi-purpose planning. We haven't really touched on death benefit yet.
Well, I think the fact that there is a death benefit and you're using this for college is a good thing because, like I said, if something happens to one of the parents that would have put them in a financial situation where they no longer can afford college, that child is maybe out in their junior year. So it kind of protects against that.
All right. We're talking about permanent life insurance strength versus 529 plans. We talked about it a lot. Do you want to talk about the structure a little bit? I noticed we're talking about death benefit and separate cash value account and these kind of things.
Yeah. So when we deal with a life insurance, for every dollar you pay in premiums, a portion goes towards the death benefit, and then another portion is diverted to a separate cash value account. So basically, you're overfunding the policy. Obviously, the death benefit has a cost to it, but you're putting in more than is needed. And that extra money is going into your tax-deferred, tax-free cash value that's earning interest and dividends and compounding pretty significantly. But from an investment perspective, whole life insurance is generally the safest kind of permanent life insurance. The issuer credits your account, again, by a guaranteed amount, and then pays you your annual dividends. And that's, again, based on their claim rate and the mortality rate. It has nothing to do with the stock market. And at this point of the world situation, people are looking for things that are not connected to the stock market. So
I'm sure you can talk about people's perceptions right now, calling you. Even when the markets are good, this is such a great safe haven asset that, to rely on and have something in your I guess your portfolio that you're not worried about, of course.
Right. Because who doesn't like something that is consistent?
Yeah.
Really. That you know what you're going to have.
Right. Peace of mind. Yes, for sure.
Yeah. A return of 3 to 6%, but you also have to remember that return is tax-free. So equate that to what you would make in the market that's not tax-free.
This gets into a lot of our content and the things that we talk about, and you can run the numbers. And so I encourage people, if you're getting started for the first time looking at permanent whole life insurance, high cash value, recognize a couple things. One, you need to have somebody skilled like Denise designing it, because not every life insurance person's going to even begin to know how to properly add the cash value and work with the death benefit and these kinds of things to maximize the cash value.
Percent of agents know how to run it correctly.
Yeah. So we value our experts. And one more advantage I'll just point out is these tax-free loans that when you do withdraw from a policy for any reason, if you take a policy loan, there's no tax implications on that.
I want to add one extra thing to your loan statement.
Okay.
And when you take a tax-free loan, not only are you not having to, not having a taxable event, but when you borrow from these policies, you are still earning interest and dividends on that borrowed money. There is no other vehicle on the planet that you can take money out of an account and still earn interest and dividends on it.
This is a college saving and funding webinar. However, we're hinting at the power of this asset and utilizing it to create, leverage and momentum with your finances. Denise, I know you've got an example brewing here.
I based this, and this is on an 8-year-old. So we have 10 years to save for college. And the average yearly cost in 10 years looks to be around $80,000. That's what they're projecting. So that's how I'm going to demonstrate the illustration on what you need to do to get $80,000 in 10 years for your child to go to 4 years of college.
And that could even be, is that what you're seeing, or is that just sort of a medium point? Because that could even be on the lower end, I suppose.
That's kind of, it's funny because I just had a call with a client and she had an 8-year-old. We were talking about college and they were looking at a policy for infinite banking. And I said, guess what? You've got both in one thing.
Yeah.
You can do your infinite banking. You can do your kids' college, pay off the loans that you take out for your kids' college, and still have your retirement income. So versatile. It's great.
So you pinpointed 80,000 as being a good.
Yes, yeah. I did some research, and that's what that didn't come out of my head. I was actually looked that up.
Right.
And that's what they were projecting that college funding would be in 10 years from now.
Yep.
Just to give you an example of what this looks like for you. So, and in order to save $80,000 by 2032, which is in 10 years, you would need to put aside $2,666 a month. This illustration is funded with $2,000 a month. And I'm going to show you how you can put that $2,000 in a month, earn interest and dividends, have that cash value grow, and then take out that loan. So basically this is, we're going to
So this is, so Denise, just to give a little more context. So this is one that you did for, you actually ran this illustration, and this is one you did for a 35-year-old that is looking to basically put 2,000 a month total into a policy. And then you did a blend on that, right? So you blended some, you wanted to maximize how much cash could be put in, and so you did some design work on this.
Yes, absolutely. So anytime that we do a policy that we want to maximize the cash value, is we want to keep that death benefit as low as possible, but big enough to hold the money that we want to put in. You might say, well, why is there a limit? Because there is what we call a modified endowment contract, or MEC limit, which is big in the infinite banking world. Basically an IRS regulation saying, hey, you know something, you're treating this like an investment. You're putting too much money in based on the death benefit, and we're not going to give you tax-free growth. So we always want to stay under that limit so that all of our growth is taxable. So it's kind of like an IRS regulation of how much money we can put into a specific death benefit. So if I'm looking to put,
it means it's a good, to me, it means it's a good deal. And
absolutely. Yes. So if we need to put $24,000 a year into this policy, we need a death benefit of $550,000. So that's the death benefit of this, and you're only ever paying for that $550,000, even though your death benefit keeps increasing bigger and bigger, because the reason it's increasing is because the money you're putting in is going into the death benefit, so that if you die, you don't lose the money that you've put into your policy. It's represented in your death benefit.
Yeah, people get confused about that. The cash value
Very
is
confused.
Funding and building that death benefit.
Yeah. So if we just kind of look at just this first line here, we're putting in $24,000 for the year, and our net cash value at the end of that year is $18,664. So as you can see, of the $24,000 you put in this policy, $18,664 was actually kind of like overfunding. That went into your bank account, and it increased the death benefit year one. Remember, we started at $550. We're already up to $612.
Right, and that's immediate cash value in. So a lot of that is just that you've got your account starting out first year.
That's right. And the nice thing about these policies is there really is a very minimal, if any, waiting period to take a loan. So if you literally gave them a check for $24,000, within 30 days you could borrow against the $18,664.
Yes,
that's how liquid it is. And that's the reason why I say people are more apt to put more money into it, because they're not afraid that, oh my God, if I put, 2,000 into my 529 plan, I put it in there and I can't get it out. Whereas you put it in here, if you put 2,000 in, you can get 18,000 out at the end of the year. So it is a lot more liquid.
Well, right. So, and now people need to also know that eventually your cash account is going to surpass what you've got in. That's so this is just year one that we're looking at now.
Right. So let's say, all right, we're putting it in for the 10 years that we need to put it in. We've put in 240,000. Well, actually, if we look at year 9, because year 10 shows the money coming out.
You did some income there. Yep. So you withdrew 80,000 for tuition in year 10.
Exactly. Right. So let's just look at year 9 for a second. You've put in 216. You have 243. Basically, you're breaking even. What we call it breaking even is meaning what you've put in and what you have is now surpassing, your gains are now surpassing what you've put in. And that's usually around year 6. And that's how you can tell you have a good plan, if it's between years 5 and year 6.
Interesting. And they've got, at that point, almost $1 million worth of permanent death benefit, which is exciting there, guys. That's if you're 35 and listening to this, or, whatever age, to me as an estate planner, that permanent death benefit is rock solid, and it's exciting because even other kinds of permanent life don't really offer that amount of assurance. That's right.
If this was an ordinary whole life policy, you would not see this break even till probably year 15 or 20.
Yeah.
So if you ever get an illustration from someone and the break even is down, all the way down there, you need to call me.
Well,
'Cause
yeah,
that's wrong.
and that's a great point, Denise. So, and a lot of the criticisms out there, some of the even the pundits out there, that's really what they're talking about, right? When they criticize this, they're talking about a traditionally designed whole life policy without any paid up cash value, and just
Exactly.
base premium and death benefit.
Right.
Yeah,
Right.
different animal.
Yeah. Yeah. And to be perfectly honest, when people want a traditional whole life policy with me, I teach them this before I have them decide on that, because I don't even like to offer a traditional whole life when you can have this. It just
Right,
doesn't make
because
sense.
well,
Because
right,
the death
because
benefit's going to grow to what they need it to be anyhow.
yeah, and your knowledge of design, right? You're blending some term in the early years into this, and that creates a very inexpensive death benefit.
So let's go back to year 10. So now we're in year 10, and Joey's going to college, and you need $80,000. You're going to take a loan from your policy of $80,000. Your total net cash value was $243. It does show that it's diminishing here only because it's an illustration, but this full amount is still earning interest and dividends for you. Even though you took 80,000 out, that's still earning for you. And when you take a loan, the cash value is not really affected. It's the death benefit that they're using for collateral. So basically that 80,000 is coming right off your death benefit right here. And you'll never get anything from the insurance company saying, hey, we need $300 a month towards your loan. They really do not care if you ever pay it back. They probably hope you don't. Because when you take out a loan, they are going to charge you an interest rate. And that interest rate is variable. In most companies right now, it's around 4%. And it's
no
always
credit,
smart.
no credit. They don't pull credit or anything like that.
No, this is we call it a loan, but it's really just a withdrawal from your savings account is all it is. But it needs to be called a loan so that it's tax free.
So Denise, help me understand so you got 80,000 of income, which that could either be a policy loan or it could be actual cash withdrawal. But then you got the loan balance of 5710. So how did it work in this case?
So they're going to take your basis first. So they're not going to be charging you 4% on all of that 80,000. Only on what part is the loan, which is the 5710, because you've already put this money in your account.
So you took it down to basis in that year 10,
yes.
And then
the balance first and then loans.
The balance was a policy loan. So but what you're saying is there's flexibility there too. If you wanted to do the whole thing in a policy loan.
But as you can see, you can withdraw it for 4 years. Your death benefit does drop. And then if you never decide to pay it back, you don't have to pay it back. If you don't pay it back, it's just going to stay off your death benefit. But your cash value is still going to earn interest and dividends and compound and still continue to push up that death benefit. Because as your cash value grows, your death benefit grows.
You touched on this, so you could use this for multiple purposes. So you could use this for retirement planning down the road. So maybe you're funding college for a while. Maybe you don't pay that back because it's just drawing down the death benefit. You could start regular withdrawals later for retirement planning.
So let's say you retire at the age of 60. We'll let you retire early. At the age of 60, you have not paid your college loans back, but yet you still have $549,000 of cash value that you could use for retirement income. And you can just take that out as loan, so it's tax free. You can say, hey, something, I need so much in my checking account each and every month. You can have them deposit that into your checking account each and every month. Or you can say, something, I would like this 549 to last for a lifetime. And you could actually annuitize these. You could take that and they would say, okay, you're 60, your mortality table is to 82. We'll just divide that evenly over those years, and we'll give you that amount of money pretty much for the rest of your life, past 82, whatever. So you can turn it into, if you annuitize it, and I'm probably getting into a whole other subject here, but you would lose your death benefit because you are pretty much exchanging your life policy for a income annuity. But it's an option that's always available.
That sounds like another webinar for us.
Yeah, I think, maybe.
But that's a great point, though. In other words, that there's so many aspects, the flexibility that you have.
And I think one really point that I always like to tell people, because everyone says, like, I don't want to pay this till I'm age 100. No, nobody wants to pay till they're age 100, and you don't have to pay till you're age 100. So I always like to teach people, how do I stop paying this? Like, maybe you're Joey goes to college and you don't want to fund this anymore ever. So what is called a reduced paid up is we can shut this off. Pretty much. We can't, pretty much anytime after 7 years. A lot of times if you try to shut it off before 7 years, it's going to create that mech condition. But if you want to just fund it for 15 years or just until he's out of school, then we would just do what we call a reduced paid up. And basically what that is we're just telling the insurance company that we no longer want any more premiums due on this contract. We don't want any more financial obligation. And they'll say, that's fine. You've given us this amount of money over the past 15 years, and that amount of money has purchased you a death benefit of. And instead of 908, they're going to reduce it. I don't know, maybe down to 6.
Yeah.
And then they'll reduce it. No more premiums can go in, but your cash value is still going to earn interest and dividends like it's done since day one. So it's still going to grow, and it's still going to push up that reduced death benefit. So maybe usually within 3 or 4 years, you're back to your 908. And from that point forward, it's just going to continue to grow, even though you're not putting any money into it, just because of the compounding effect of the cash value. Pretty awesome.
That's awesome. And some people that mentored me over the years and talked about doing the hard things early on. This is such a good example of that, I think. Is that, obviously you're spending money, you're funding this thing up front. But look at the power later on that you have, the flexibility, the options. Denise, I want to do a lot more webinars with you. I think this has been really informative and hopefully really practical for folks that have tuned in. Thank you guys for joining us. If you're at a point where you want to look at this for yourself, in other words, for your age and your situation, your budget, Denise is going to be available. This is her calendar link. You can actually access it with this link. We'll also have, most places that you're watching, we'll also have a button below, or you can email Denise at Denise@InsuranceandEstates.com to just request a personal meeting, either Zoom or a phone call to get started. Denise, do you have any other parting thoughts?
I do. I don't want the $2,000 a month to shy people away, because it doesn't have to be $2,000 a month. Something is better than nothing. You do what you can afford and that you're comfortable with. But again, something is always better than nothing.
Keep an eye out for future topics that with Denise. We'll be rolling out some more, and I think we may even hinted at a couple of them today. So Denise, much appreciated, and looking forward to doing some more of these. And thank you for all that you're doing to help folks, help the I&E tribe here.